Welcome to Business Reporter's Future of Financial Services and Banking campaign. Now, since the financial crisis in 2008, new rules on mandatory capital reserves have made it harder for banks to do what they should be doing, managing multiple investments, loaning as much as possible, and delivering high returns to investors. So what can be done to address these problems? And more specifically, how can technology enable banks' expanded access to capital within the current constraints? This is what we're going to discuss today with Gil Mandelzis, CEO of Capitolis. The amount and complexity of regulation in finance has grown since 2008. What problems has this caused banks?
So, on the back of the financial crisis, obviously the regulators had to work in concert all over the world to relook at the fundamentals of the financial system and make sure we never need to bail out banks or the financial system ever again. And they put together a set of very effective regulations that were meant to basically shrink the exposure of overall economies to the large banks from a credit perspective. And they've done that through reducing their leverage, reducing the activity that is done off balance sheet, etc. The end result has been fantastic in the sense that the world is definitely safer today. And we've just gone through a pandemic, and not for a second were we worried about a large bank failing, which is fantastic. The unintended consequence of that, or a consequence of that, is that the overall wholesale banking capacity in the world has shrunk. When we're looking at we'll play this several years forward to where we are today and for the decades to come, the world is literally running out of certain capacity for certain offering and services, such as clearing, such as certain loan extension to corporations, etc. That is the problem that we're coming in to solve, in that, yes, the world is safer, but the world of wholesale banking needs more capacity, especially around financing and capital.
How is Capitolis enabling banks to access greater capital?
Yeah, so capital is not a problem in the world. There is tons of capital out there, and there is much more created every month. The problem is, and this is, by the way, sophisticated capital held by institutions that can totally understand the opportunities generated and originated by the large banks. The problem is access. The problem is that those investors don't have access to many of those opportunities that we're talking about originated by the banks. And at the same time, the large banks who are originating all of these opportunities don't have access to many of those investors that are out there. And that is where Capitolis basically comes in democratizing access to these opportunities to effectively any institutional investors that are out there. We're doing it through our network, we're doing it through our technology, and that basically allows the free flow of capital from institutional investors into the wholesale financial system in partnership with the large banks.
So how is this a win-win for investors and banks as well as regulators?
We think that the entire system wins. That's what's so exciting for us, is the ability to truly rethink the model to a model where everybody wins. So if you think about the banks themselves, we're solving for the large banks their most meaningful constraint, in that they can offer those super scalable services, technology, operations, trading, etc., while relying on capital that would come from elsewhere. So this is their biggest bottleneck. They obviously win. For people with capital, for institutions with capital, we're presenting them now with trillions of dollars of new investment opportunities that they did not have access to before at very attractive returns. The end client gets to benefit from the best of both worlds. You have the access of the services of the largest banks, the best services that are out there, with more capital and a lower cost of capital that would come from the rest of the market. And then if you think about it from the regulator's perspective, we believe we're fulfilling exactly what they wanted. We're helping reduce the overall exposure to the large banks from a credit or capital perspective. We're keeping them very safe. While we're doing that, we're bringing tons of new capital. We're shoring up the system with tons of new capital. It is cheaper capital. And importantly, it's non-systemic capital, which means that if something went wrong, we as taxpayers do not need to step in and bail out the system. So we're helping the system remain safe, but we're also helping its growth and helping the overall system become much more thriving.